Hello, with me today I have Dave Bujnowski, Portfolio Manager at the Baillie Gifford American Fund. Now, investors find it relatively easy to buy stocks, but struggle to know when is the right time to sell. I just wonder, for you, what are the telltale signs that make you hit the sell button?
For us, it's pretty simple, and I'll take it back to our process once again. We're disciplined to sell buttons, I guess, as you say, come in two ways. One is based on an assessment of fundamentals. The other is based on math. So relative to the first, on fundamentals, we have a forward-looking hypothesis for every company in the portfolio. Here's what we think will happen for the next 5 to 10 years, given the market, given this company's competitive edge, given its culture, given its financial characteristics, given its business model. And if the signals that we're receiving tell us that that thesis is broken, we will sell. And we'll sell regardless of whether the stock is cheap or expensive. It's purely about the fundamental forward-looking hypothesis. The second I mentioned is on the math. This involves that 2.5 times upside case that I mentioned. That is, if the forward-looking hypothesis holds and things go right, is there still a plausible case for 2.5 times upside given the size of the opportunity? And of course, given what type of valuation would be demanded in 5 years to generate that type of 2.5 times upside. If the math simply doesn't work, we should consider a sale. I guess the nuance here that I want to emphasize or highlight about that latter, the math, is the difference between consensus near-term valuation metrics and the 5-year 2.5 times upside case that we use. So for instance, let's say you have a software stock trading at 30 times forward sales. It's typically a 1-year forward sale metric or a 1 year behind historical measure. By historical measures, such a valuation might be considered unreasonable by many. But let's say this company compounds revenue growth at 40% over the next 5 years. Now in this situation, if you run the math, in 5 years, a valuation of 14 times, that's less than half of our starting point of 30 times, would be required to generate that type of upside, that 2.5 times upside from today. Now, my point is not whether the 14 times is necessarily inexpensive or expensive or reasonable or not. Rather, it's simply to illustrate our sell discipline. It's based on that type of time horizon, not a conventional near-term metric.
Now, you've talked a bit about Tesla, Shopify, Wayfair, Alphabet. I mean, the share prices have exploded in the past few months. But just wondering, are there any companies that you think are so-called one-decision stocks?
No, I don't think there are any one-decision stocks. Of course, we invest in every company with the expectation and the hope that we own it for a very long time. But an investor needs to continually scrutinize the holding, especially in the disruptive times that we're living in. I think complacency will do you very little good in times like this. And that takes me really back to the last question. Is the thesis intact given all of the signals that we see that are taking place in the market and around the business? Is the thesis intact? And if so, is there still room for the required upside? So you asked about Tesla. If I were to apply this to Tesla without getting too deep into the math, thinking about what the stock has done over the past year adds very little value to our process. That it is up 500% is irrelevant. We start with today and focus on the next 5 years and what the upside might be if things go right. In Tesla's case, we have an addressable automotive market in the trillions of dollars, emerging technology, electric vehicles that we think spells the future of automobiles, yet is barely penetrated at perhaps 2% penetration. And a competitive edge for Tesla that has given the company 3/4 of the US electric vehicle market and that only seems to be strengthening. We haven't yet gotten to its storage business or its solar business, both large themselves. So given all this, rolling the tape forward, can Tesla be a much larger company from today? If we come out of that exercise doubtful, then yes, we should consider selling. And as yet, that hasn't been the case.
About 2% of the fund is still in cash. So that's pretty low. Just wondering, is that a normal level for your fund to hold? And what kind of opportunities are you still looking for?
Yeah, the cash position, it's normal, but we're always looking for new ideas. I guess the fund is a competition for capital. If we have 40 to 50 companies, we're constantly looking to be invested in the 40 to 50 exceptional growth companies. So it's a competition. Our purchases, going back to your question about the cash, our purchases typically don't come out of the cash position, come out of typically a sale of existing positions. We're always working on new companies to make that 40 to 50 the most exceptional of the thousands available to us in the universe. So for context, given our turnover, we typically seek just 8 to 8 new companies per year. And in 2020, we're tracking ahead of that. So our pipeline of ideas is actually quite full. As far as areas, I mentioned enterprise software and the cloud. I can't emphasize enough just how dynamic that is, and how disruptive and how many interesting new dynamics that I think are underappreciated are taking place in the world of enterprise software. So that's one trend. Another theme that I am just very enthusiastic about generally, and this is going to be quite general, it's looking for industries or markets or systems that have actually historically, to this point, been slow to change. And I think some investors might look at those types of situations and walk away from them, a growth investor, and walk away from them thinking it's inert, change doesn't happen here, it's not overly disruptive, let's go elsewhere because this system doesn't change. I think the opposite. I think I look for those situations, my team looks for those situations, because I think the disruptive forces, some of which we're talking about today, whether it's in e-commerce or enterprise software or the media landscape, Netflix and cord cutting and things like that, those don't live in a vacuum. I think that they're being shaped by technological forces and cultural forces that will seep into other industries and other systems. So just because a system has thus far been relatively inert, I see more so as an opportunity for future change to come from there and new ideas to emerge from there. Coming back, this really informed our views on Carvana and Vroom when it comes to used cars, or Lemonade in the insurance industry. Industries that have been slow to change, but that we think are on the cusp of tremendous change.
Finally, Dave, do you have any words of wisdom for growth investors at the moment, given the extreme rally in US technology stocks and inflated valuations? Should they be looking elsewhere, do you think?
I think first, as growth investors, one question we get and have gotten a lot over the years is around the growth versus value debate in the first place, and whether the best of the growth categories days are now behind it after the outperformance that is now over a decade long. And my first thought on that debate is actually that it's a bit of a red herring, at least for us as active investors. We don't spend that much time we don't spend any time thinking about the growth and value categories. As active investors, we spend time thinking about things at the stock level. So the question I attack isn't so much about the rally in the US tech sector. It's whether I can construct a portfolio that has 40 to 50 exceptional individual ideas in it. And that brings me to point number 2, which I think is probably more in the spirit of your question. And that's whether the current environment allows for the construction of 40 to 50 really exceptional growth ideas, given where we are today. And my answer is unequivocally yes. I wrote a white paper early last year called The Case for Growth, which kind of put this question on the table about the growth versus value dynamic. And the gist of the piece, or the growth versus value argument debate, and the gist of the piece was that in periods of great disruption and innovation, the notion that stocks will revert to an intrinsic value, as Benjamin Graham wrote about in The Intelligent Investor decades ago, doesn't hold as much weight as it would during a normal economic cycle. Disruption brings dislocation between end demand, sort of what we consumers want, and what is being supplied by the companies that we invest in, the suppliers. And when there's dislocation between that demand and supply, it's an opportunity for an innovator to address that demand in a better way and grow. So I think that is a dynamic that sits behind a lot of the great growth opportunities of our time. And for the past decade, multiple forces have been coinciding that are leading to a prolonged period of great disruption that's nowhere near played itself out. Now, I guess I'd end with, we hear the word disruption thrown around a lot. I don't think it's overly controversial or even all that original to consider that these are disruptive times. But if you think about just how many forces are contributing to this disruption all at once, disruptions involving the connection of 7 billion people with the internet, or the emergence of the cloud and the very infrastructure that supports how businesses are run, or the unearthing of new types of data that can be turned into miraculous insights, each of these brings a tremendous opportunity for entrepreneurs in their own rights, yet it's all happening at once. And I think this is unprecedented. So yes, against that backdrop, as a long-term growth investor, I see fertile grounds for investment opportunities for years to come.
Dave Bujnowski, Portfolio Manager at the Baillie Gifford American Fund. Thank you very much.
Thanks, Lee.